Taxes in retirement and Roth IRA conversion. So this agent comes to me, one of my 400 or so agents, a couple weeks ago and says, Charlie, we're projecting that this client has zero tax liability in the year 2030 when they're 73 years of age. Zero tax liability. How is this possible, Charlie, when their adjusted gross income, when they have income to the tune of like $30,000? How is it possible that their bottom line tax liability to the feds, to the IRS, is zero? Something has to be wrong here. So I said, nope, it's not wrong. And here's the explanation. And I gave him the explanation, which I'm going to give you here in a bit. And through this lens, as I give you the explanation, I want to talk about Roth IRA conversions as well as taxes in retirement. And then I'll sum it up with giving you that explanation. By the way, my name's Charlie Gipple. I'm the owner of CG Financial Group. I'm a certified financial planner, and this is one of the areas that I specialize in, Roth IRA conversion analysis, which again is kind of the lens that we will, talk about, well, what we're going to talk about here. So Roth IRA conversions are a popular topic today, especially from some of the pundits on TV that frankly have knowledge that's an inch deep and a mile wide. A mile wide as in they know about a lot of stuff, but when somebody with a pretty experienced eyeball looks at the information that they're given, I'm not going to name names, but when somebody with an experienced eyeball looks at the information they're given, it's like, yeah, but there are so many other considerations you have to look at. You can't just make that blanket statement that everybody on the planet should convert all of their pre-tax dollars to Roth IRA money because tax rates are going to go up in the future. What about their specific tax rate at retirement versus where it is today? Just because tax rates in general are going to increase, and yes, I believe that they will because we're $36 trillion in debt as a nation, it doesn't mean that that person's tax rate is going to increase. If somebody's making $800,000 today at their job, they're in a high tax bracket, right? When they retire, even if they have a couple $100,000 in retirement income coming in, they might potentially be in a lower tax bracket themselves, specifically in their retirement years than they are so a lot of blanket statements. One of the blanket statements is, if you want a zero tax in retirement on that retirement income, like the agent observed at the beginning of my talk, that we often get clients to, then convert all of your money to a Roth IRA. That's hugely simplified. So here's an example. Or let me step back for a second. Let's say that I want zero taxes in retirement, but I have $2 million in pre-tax dollars. $2 million in pre-tax dollars. Should I convert all of that money to a Roth IRA? Forget all the other income that I'm going to have in retirement, Social Security and all that. Just looking at these pre-tax dollars, should I convert all of my traditional IRA money to a Roth IRA? And by the way, with a traditional IRA, you have to pay tax on that when you cash it out in your retirement years. In general, assuming it's a deductible traditional IRA. Conversely, with a Roth IRA, you don't have to pay any taxes in retirement, right? So would I convert all of my traditional money to a Roth IRA today? The answer to that question is heck no, I wouldn't, to oversimplify this. Well, Charlie, how much might you convert to a Roth IRA? Maybe all of it except for $750,000. Okay, that's a random number. Where did you come up with that? Again, greatly oversimplified, but I just want to open your mind up to something that's out there that started the conversation with this agent here. And it has to do with standard deductions. So assuming today's standard deduction level is the same as what it will be in the future, which is a big assumption. Of course, we have different variations that we use in our Roth IRA analysis, et cetera, et cetera. It would be dumb of me to convert all of that traditional IRA money to a Roth IRA because it is possible that with $750,000 of that money, I may never, ever, ever have to pay taxes on it. So let me explain. Now, first of all, if one didn't want to pay any taxes, could they just say, well, my pre-tax dollars, I'm just going to keep it invested forever. Heck, I'll die with that. I'll never cash it out, and therefore I'll never pay a penny of taxes on that pre-tax money. The answer to the question is you can't do that. You can't do that. The government's ahead of us on this, and that the government says, oh no, once you hit a certain age 73 for folks that were born prior to 1960, age 75 for those that were born 1960 and later. At that age, you have to start cashing out your pre-tax dollars. And these are called required minimum distributions, RMDs. People hate RMDs that hate taxes. You're forced to cash out a certain amount of money each year based off of these tables and pay taxes to the IRS. So for me at age 75, it's around 4%, 1/25 or so of my pre-tax dollars that I would have to cash out. Okay, so where did you come up with the $750,000? It's the backwards math. So if you take $750,000, 1/4 of, or 4% rather, of $750,000, that comes out to, I would be required at age 75 to cash out as an RMD $30,000. And that number is a magical number based off today's dollar amounts, because that's the standard deduction today, right? The way our tax system works is you have all your sources of income, you have adjustments to income, and that's your adjusted gross income right there, line 11 of your tax return. But then from that number, you have either a standard deduction or an itemized deduction. And for a 65-year-old couple today, that standard deduction is around $33,000. Wipes out $33,000 of the income. Whatever is left over is the taxable income. So this is how we started the conversation. At the beginning of the conversation, my agent said they have 30 grand in income but zero tax liability. Yeah, because that $30,000 is being reduced by $33,000. They have zero tax liability. They have negative $3,000 as taxable income, right? So when we talk about Roth IRA conversions, why would we pay taxes on that $750,000 if the standard deduction can otherwise absorb the RMDs that would be generated from that $750,000? Anyway, I know this is technical, but this is just a way to get you to open your eyeballs up to some of the more nuanced discussions around Roth IRA conversions. If you like this video, give me a thumbs up. Also subscribe. Also, let me know if you have any questions, and I could run you a Roth IRA conversion report that a lot of folks love.